Ethereum is trading within a hair's breadth of its all-time high, which is a few percent shy. And the broader altcoin universe is awash with liquidity and leverage. Glassnode's headline number of roughly $47 billion in total leverage on top. Altcoins is not just big, it's tectonic, because it means a single, focused shock can cascade through dozens of assets at once and transform a constructive move into a liquidation spiral, or alternatively, a self-reinforcing rally. To understand what this moment actually means, whether it's an epical breakout to new highs or a classic blow-off followed by a painful reversion, we need to look at the anatomy of the move from multiple angles. The macro backdrop and ETF flows that are supplying fresh oxygen. It's the derivatives footprint that amplifies both direction and risk. The on-chain and microstructure signals that tell us whether demand is durable or merely mechanical. And crucially, the scenarios and risk management playbook that separate opportunistic traders from those who get burned. Start with the catalysts. The macro narrative has tilted in favor of risk assets. Softer CPI prints and growing market expectations for eventual rate cuts have reopened the gates for yield-seeking capital. In this environment, institutional products matter. Spot ETHs and similar institutional rails act as both signaling devices and as actual demand conduits. When large allocators build ETF exposure, they bring size and stickiness that historically has supported extended market rallies. Jag Kuhner's point that ETF flows, institutional accumulation, and an accommodating macro setup are driving ETF. Momentum is not speculative, it's mechanistic. ETFs aggregate demand, create predictable periodic flows, and reduce the relative float available for tactical traders. All things that can push a high-liquidity asset like ETH towards new highs. Those same flows reverberate through the altcoin market as capital rotates from cash or BTC into ETH. A portion of that marginal liquidity typically trickles down toward higher beta altcoins, producing the multi-asset lift we are seeing in Doge, XRP, SOL, and others. That dynamic is amplified by today's extraordinary derivatives positioning. Open interest in ETH options around $16.1 billion in record or near record OI in futures suggests notable institutional and speculative engagement. The fact that buyers were willing to spend $82 million on calls in a single session and another $31.5 million on a subsequent day underscores a market that's paying up for bullish optionality. It's not merely nibbling at the edges. The apparent paradox: rising OI and heavy call buying while implied volatility remains muted tells a nuanced story. The market is positioning for a breakout but is not pricing in extreme tail risk. In other words, many players are long convexity with moderate hedges rather than terrified sellers, creating a situation where an up move can be accelerated by dealer hedging flows gamma buying, while a downside shock can devastate levered longs. From a technical perspective, ETH being only 2.7% or 3.9% away from its ATH matters because human psychology and automated systems both treat that distance as a threshold. Some algorithms and trend followers switch on at those levels. Retail fear of missing out FOMO accelerates order flow, and stop clusters above the prior high can act as magnets that feed into short covering squeezes. Put together, the confluence of macro flows and technical thresholds gives bulls a credible path to new highs. And if ETH does make an ATH with constructive breadth behind it, the market could rotate into an even broader risk-on regime where altcoins lead successive legs higher as capital chases alpha. That's the upside case. And it's compelling because it's not rooted in thin hope, but in the interplay of productized demand ETFs, institutional accumulation, and macro liquidity. But the very features that make the upside plausible are also what make the environment febrile and fragile. When Glassnode tells us that total leverage on altcoins has swelled to $47 billion, the immediate implication is that a large, rapid price move up or down will trigger cascades of margin calls and automatic deleveraging. Leverage is a force multiplier. It turns a 5% move into a much larger realized P&L for participants and turns stop hunt mechanics into a short, violent feedback loop. That's why Kuhner's compressed spring metaphor is apt. The market appears calm enough that implied volume is not spiking, but the positioning underneath is highly sensitive to shocks. If any macro tremor, an unexpected hawkish Fed comment, a geopolitical escalation, or even a single large liquidity-draining block trade hits the market, leverage will transmit that shock very quickly across correlated altcoins, the options. Market's low implied volatility amid rising call buying is a double-edged sword. It lowers hedging costs and allows players to buy asymmetric upside cheaply. But it also leaves dealers with less premium cushion and forces mechanical hedging. That can amplify moves when dealers dynamically adjust their delta exposure as the market moves. Another risk is concentration and funding dynamics, as margin positions grow. Funding rates and the skew in futures markets can flip rapidly. The funding turns strongly negative for longs. The cost of carrying long exposure increases in capital. Can be withdrawn, creating fertile ground for corrections. Liquidity depth matters too, even though ETH is liquid relative to other assets. Altcoins suffer from shallow order books at critical levels. $47 billion of leverage distributed across many small markets means that a localized liquidity vacuum can generate outsized cross-asset volatility. Add to this the behavioral risk inherent to a momentum-driven rally, profit-taking by early holders, headline-driven panic selling, and social media amplification creating crowded trades, and the downside scenario becomes not just possible, but plausible. So what does prudent strategy look like in this crucible? The answer depends on your horizon and role: momentum trader, swing trader, institutional allocator, or long-term investor. For momentum traders, the edge lies in real-time risk management and rapid reaction. Capitalize on gamma flows and liquidity, but keep position sizes small relative to available margin. Use tight systematic stops, and prefer trading instruments that offer defined risk exposure, for example, buying call spreads instead of naked calls, or using inverse ETFs for short exposure. Pay attention to immediate signals. Funding rates. Near-term implied volume changes, dramatic shifts in options skew a sudden surge in puts, and rapid increases in exchange balances, which can presage distribution. Look for swing traders. Look for higher time frame confirmation, weekly closes above prior highs, sustained decline in exchange reserves indicating accumulation into custody rather than intraday rotations. Swing traders should scale into positions with a clear ladder of profit targets and hedges, since the move can be extended but is always vulnerable to a swift retracement. For institutional allocators, the calculus is about durability. Is the ETF and custody pipeline converting announced interest into on-the-ground allocations? Institutions should phase allocations into milestones, for example, sustained ETF inflows, custody signings, regulatory clarity, and employ overlays such as portfolio-level hedges against systemic crypto drawdowns. Long-term investors, those who believe in ETH's role as base settlement and smart contract infrastructure, should ask whether the current rally materially changes adoption metrics, TVL, active addresses, settlement volumes, or is largely speculative. If adoption data is improving alongside price, then increasing exposure makes sense on a longer time frame. Otherwise, keep buys disciplined and gradual. Operationally, there are concrete data points to monitor that will tell you which regime we're in first. ETF flows and institutional custody inflows. Consistent net positive flows are the best evidence of durable demand. Second, on-chain metrics for ETH, active addresses, smart contract interactions, DeFi TVL, which reveal whether fundamental usage backs price. Third, exchange supply dynamics falling. Exchange balances typically indicate accumulation, while rising balances warn of potential distribution. Fourth, derivatives indicators, total OI, funding rates. Options skew and concentrated open interest near particular strikes reveal where the system's pain points are located. Fifth, macro indicators, CPI, Fed speak, and rates expectations are the external levers that can snap the leveraged web. If these signals align bullishly, ETFs keep taking in money, on-chain usage expands, exchanges bleed supply, OI growth is steady, but funding is not excessively one-sided. Macro moves remain benign. Then the probability of ETH printing new ATHs with altcoins participating in the follow-through is meaningfully elevated. If any of these signals flip, sharply rising exchange inflows, a sudden spike in put buying, a jump in implied volume, or an adverse macro headline, the $47 billion of leverage turns from an accelerant into an accelerant for liquidation. A multi-asset correction becomes the high-probability outcome. Finally, think in scenarios rather than absolutes. The bullish scenario is a staged process. ETH breaks a TH with clean confirmation and volume. TFs continue to net accumulate, institutional custody flows lock in a portion of supply. Altcoins capture secondary rotation bids and leverage gets digested into longer duration positioning rather than short-term speculation in that case. Market transitions from a leveraged squeeze to a broadening rally.